Good afternoon, and thank you for joining us. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's Higher Education Virtual Town Hall. We received several questions from many of you in advance for today's session, so thank you for that. We'll start off the town hall addressing these questions, but if you would like to submit a question for our presenters, please submit them through the Q&A inbox, and we will try to get to them as time permits. And before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, now that we have our housekeeping items out of the way, I'd like to turn it over to Melissa Harman, Moss Adams partner and Higher Education National Practice Leader, to get us started. Melissa?
Thank you, Amy. Good afternoon, everybody. Thank you so much for joining us for this town hall. We really appreciate your time today. We're excited as a partner with you in higher education. We serve over 150 institutions and have been doing this for 30 plus years. Absolutely want to share what we're seeing, what we're hearing, and what you need to watch out for as an institution of higher education. We've got a great set of speakers today and panelists to go through some of those emerging issues, what's top of mind, and some of the risks that are associated with your institutions. Today with me is Tammy Erickson. She is an audit partner. I was doing the math on all of this. We have over 100 years of experience on this call and this panel. So you've got a deep breadth of institutional knowledge that has been working in the higher education space for years. Lauren is our tax partner that's going to go through some of those questions. Matt is also an assurance partner and one of our federal audit experts. Matt Dinsdale is sick today, will not be joining us. So Matt is covering both Matts today. And then Kim is joining us. She's a tax exempt attorney that specializes in tax exempt organizations, including institutions of higher education. She sits on the tax exempt organization committee for the American Bar Association and has deep knowledge. There's some stuff going on, obviously, with the SCOTUS cases and how they apply to our institutions that we definitely want to cover. So really do appreciate the time and effort everyone has put into this today. And again, welcome any questions as we do go through this. I said I always start with the auditors. So today I'm going to flip it up and start with our tax side of the house and go through some of those questions. I will warn you that in between each of the speakers that we go through, we do have some polling, a little bit to add in to just spice it up a little bit. So do help us participate. We're trying to, assess where the sector is and do appreciate the time. So I'll give you a heads up when that happens. So Lauren, I will start with you. ERTC, ERC, whatever you want to call it. So we now have a moratorium. What does that mean to institutions that have applied? What does that mean to institutions that have already received? Just a lot of noise and some IRS audits that are already happening. Can you tell us what's going on in higher ed? And if I'm sitting in a business officer's shoes, what I need to be concerned about?
Yeah, that's a great question. And it's something that is really prevalent in terms of a big focus, not just on the IRS, but there's a lot of congressional oversight and questions that they have on how the IRS has handled the employee retention tax credit. So back in September, the IRS announced a moratorium on processing new ERTC claims until the end of 2023, until at least December 31st, 2023. So that's caused a little bit of an alarm with various Congress people, with the Ways and Means Committee, with the various oversight committees of how this, of the IRS essentially, and shine a spotlight into, maybe some of the IRS mismanagement on this. But really what the IRS has said is, we're still going to accept new claims. You can still submit new claims. We're just not processing anything right now because we've been finding that there's been too many companies filing that have been victims of aggressive promoters. So I think all of us on this call, I know I even receive promoter emails and messages regarding assistance that we might need for employee retention tax credit, but we've all gotten these calls that are saying, that the rules have changed and you might not have qualified in the past, but you qualify now, and we can figure this out for you up front. So because of that, IRS has found that a lot of organizations have had their claims submitted without qualifying. They're going to pause that, and they've created a couple programs to remedy anyone who feels that they might have been a victim of an aggressive scammer, with a withdrawal process for the ERTC, or a process to go through and remedy those issues, so that there's no potential criminal or other types of charges that a organization might face if they didn't properly file. But as of right now, the alarm is coming because there's over 500,000 941s that have yet to be processed by the IRS, and organizations have already experienced a bit of a delay. So this moratorium on processing is just going to exacerbate that. And then, it's estimated that the IRS has paid out $150 billion, and that there's upwards of $220 billion in the pipeline, in terms of credits that are waiting to be paid out. So it's a big program, and they're trying to wrap their arms around it. There has been talk that they might pull back. So you can file this credit. You could file if you haven't gotten the employee retention credit, it's potentially available until 2025 via amending a 941X. It's been mentioned by the IRS, although there's been no progress from a congressional standpoint, that they're going to pull that back and shorten that time frame. So more to come. Pay attention if you haven't filed one yet and you're considering it. Just be aware of those potential issues. One of the things a question that we've gotten from clients is, we filed, we're waiting, what should we do in the meantime? Should we be ready for an audit? What we're seeing in terms of IRS exams on the employee retention tax credit is that we think, we haven't gotten clarification, but really IRS is examining organizations for their entire exam, process via using things like analytics. So we're not seeing random exams. We're seeing a lot of exams based on analytics. So if you're an organization that filed an employee retention tax credit and you have more than 500 W-2s in an annual year, in a year, you might want to be prepared for some sort of follow-up or compliance check because of the limitations for larger organizations that they have. Otherwise, ensure that your documentation is ready to go. So if you obtained the ERTC based on gross receipt reduction, make sure you have those work papers that show that you qualify for all those quarters. If you're claiming that you're getting the employee retention tax credit because of the sustained or partial shutdown of operations due to government orders, make sure that you have evidence that shutdown amounts to 10% of your operations, of your business, and that there are appropriate government orders that are connected to those losses in terms of your business. So I know that's a lot on ERTC, but more to come. If you haven't filed yet, it doesn't mean that you can't file. Just be sure to talk to your tax advisors and ignore those aggressive scammers. The IRS did put out some FAQs as to what is a promoter. What is a promoter? What does that look like? And so you can look to their frequently asked questions to see a little more about what they consider an aggressive promoter.
Perfect. Lauren, you talked a little bit about how to prepare should you get selected and be a winner in an IRS audit. I want to ask the question, in what you've observed or heard, what are some of the common questions the agents have had, or where do you see them focusing in at this point? And if it's to be determined, that's fine. But I know that there's a couple prominent ones that are out there, and maybe you could share that.
Yes. So they're asking essentially for your backup, right? When you file a 941X, all you submit to the IRS is an amended payroll tax return with your credit number. So they're looking for all of your substantiation as to, how many employees do you have, and how are you calculating the number of employees that you have? Because if you have less than 500 employees, all employees are eligible, for the credit. potentially. If you have more than 500 employees, only the employees that are paid to not work are eligible for the credit. So that 500 threshold is really important. So they're looking for how that's calculated for your organization. They're looking for, how are you assessing qualified wages to obtain that credit? And then they want that evidence that you qualify based on either a gross receipt reduction or that you have the evidence linking government orders to a suspension, partial or full, of your operations. And so in higher ed, we're seeing that in terms of the auxiliary operations. You didn't have the dormitories, or your student services were shut down. You didn't have, the restaurants open and the businesses open internally because everyone went virtual. So that's what we're seeing in higher ed, is documenting that those programs that you couldn't have anyone in the dorms because of government orders, or couldn't have, in-person education because of government orders, and that would be 10% of your business, even though you were operating virtually.
Perfect. And one last question on this topic. So I amended my 941s, right? Or I'm going to amend my 941s. Do I have to go back and amend my 2020, 21, 22, my returns, tax returns, or my 990s related to this?
Yeah, and this is something that the auditors might want to jump in on too, but first, you start with the audited financial statements, and I'm not an auditor, but I do believe, based on the returns that I've seen, that that's recorded as revenue when you reasonably expect that you're going to receive it, or you receive the funds.
Yeah,
Melissa? Is that it? When you receive the
I can
funds,
jump in
right?
on that, and then you can weigh in. I'm sorry, I should have started
talk
with
about
that.
The tax.
Yeah, no, it's fine. Most clients are interpreting it as a conditional contribution, right? And that because we have not received the funds, and the measurable barrier is the acceptance and processing of the information. So a lot of our clients have waited and done a conditional contribution. Some have recorded it as a receivable. So I think it really depends, but I would say 95% of the clients that I serve have just been a little worried about this and called it a conditional contribution and waiting for that approval or the monies to come in as acceptance or removal of all barriers on conditions. Some have done the receivable, but I guess with that in mind, how does that affect the 990?
Yeah, there's been a little bit of conflicting guidance in how that affects the 990. We haven't gotten any information from the IRS as to how to account for the employee retention tax credit on the information return that is the 990. In the taxable world, so for 1120s and corporations, they would be required to go back and amend their tax returns because the credit amounts to a reduction in salaries and wages. For nonprofits, we don't know if some are doing that, some are reducing the salaries and wages, some are booking it as an adjustment to net assets. But a lot of companies are conforming with the audited financial statements because of the position that the 990 is an information return. There is no set way to do it. It's really going to be a discussion with you and your advisors and what their firm's position is, what is you're the most comfortable with as an organization. So I would say you probably don't have to go back and amend your return. Potentially the IRS doesn't like getting more paperwork. They're already full of paperwork. And so, if you can run it through the current year return and somehow communicate that to the IRS, I think that might be the best way, whether it's an adjustment to net assets, or you're reporting it consistent with how the audit's reporting it.
Yeah. And I'll just add into similarly, we received guidance and some technical questions and answers that were issued and some FQAs that were issued as it related to the financial statements. So not different than the PPP, the SBA loans. This is similar. We're not amending our financial statements. We're not reissuing financial statements. You are applying for the credit in the current period. Even though the expenditures may be tied to a previous period, that revenue recognition is associated with a current or future period. So there is no reissuance of prior year financial statements that needs to occur. So that was one of the questions we got. So pretty consistent for both sides. So
exactly.
Okay. We're going to put this baby out with the bath. Moving on from ERC. Let's talk a little bit about the energy credit. So I've heard a little bit about it. I know there's something going on. I'm an institution of higher ed. I'm always doing capital projects. Most of ours are lead projects. What is it I need to know? What's out there? How do I qualify? What do I need to do?
Yeah, so there are direct pay credit opportunities available for energy project owners and producers of energy. So that would be through, if you have an energy like wind, solar or wind or something to that effect. But the thing that's really interesting about some of these new credit provisions is that they're now accessible to nonprofits, not just 501c3 tax exempt organizations or organizations that are, tax exempt, but also to governmental entities, to public universities, to other organizations. And so this allows for direct pay credit based on the amount that you're spending and a percentage of that on certain projects. So what are the kind of opportunities? So I'm just going to go through really high level just to help you all trigger like, oh, this might be something that we're doing or considering. The first one would be if you're a producer of energy, and that would be the credit would be based on the output from your projects. And we're not seeing this one as much in the higher education space because it would be, wind, biomass projects, geothermal projects, landfill gas. I mean, this could be something that you're doing, but where we're seeing more of an opportunity would be in the investment tax credit. And so this would be for energy project owners, and the credit would be based on upfront purchases of materials or parts or labor for energy projects that are prior to 2025. So starting prior to 1/1/2025. These would be solar, fiber optic, energy efficiency projects, fuel cell, microturbine, heat, HVAC systems that you're putting in that are energy efficient. So there's a whole list of potential opportunities for organizations that are considering, putting in new buildings or putting in new projects that meet certain energy standards and have those types of benefits. And we're finding that a lot in the higher ed space to, meet the ESG missions of organizations, that this is part of what they're doing. And it's great that there's credit opportunities available there. Additionally, if you're purchasing qualified commercial vehicles, so electric vehicles, there could be a tax deduction there up to 30%. So it could be, $7,000 to $40,000 depending on the vehicle size and use of the vehicle. And finally, if you're in a certain opportunity or energy zone or low-income area or non-urban area, you could get credits for putting in electric vehicle charging stations as well. So those are kind of the main ones. There's also, I think, some zero emission nuclear, clean hydrogen benefits as well. But I think those three investments, commercial vehicles and putting in those charging stations, could be something that really could impact the tax exempt space in higher education. So if that's out, there's a requirement to pre-register certain projects if you have them going on. We'll know more about what that looks like. They haven't set up that registration process yet. And the credit will be claimed even if you don't file a tax filing with the IRS on the Form 990T. So that's something that will be considered. And if you miss that due date, then you'll miss out on that credit. So look out for more information about when that registration is coming due if you do have a project in place. And remember to consider that, that you might have a tax filing, in a given year, a 990T filing.
Okay. Perfect.
It's a lot of information on lots of different credits.
It's good. I think a lot of folks don't realize that they qualify as either a government or not-for-profit entity for some of these credits, and they're just out there. So definitely take advantage and grab them. So really appreciate that. Last question for you, and I know somebody had a question on presidential housing, so it's kind of in line with a little bit of executive compensation. So I got a compliance check, right, from the IRS on, compensation over $1 million. Do I need to be worried? Is this something I should be concerned about? What do I need to do to prepare? Is this common, and what's going on with this?
Yeah, and as I mentioned before, the IRS is doing their audits and exams based on areas that they can, basically find revenue. So that would be anywhere that there's a potential taxable impact, including compensation, and that would be on compensation, the excise tax on compensation over $1 million. So we are seeing more frequent compliance checks where the IRS is sending a letter. It's not an audit. They're sending a letter saying, hey, we got your form. We're just hoping you can provide us some more information about how you came to arrive to this number as your taxable income. So, they're reconciling the W-2s, the Box 1 and Box 5 to understand how they came up with that taxable number. And I wouldn't, my advice to clients is don't worry about it. Just make sure that you're replying quickly and completely when you get those compliance checks. And generally it clears things up. So that's what we're seeing in terms of that space. It's always of interest in terms of looking at the fringe benefit packages too of the university's president or chancellor, whatever it might be. But luckily, that compensation over $1 million is just based on essentially W-2 and taxable comp there.
Perfect. And I'm going to put you on the spot. So we had a question come in, and I know you can answer this, but remind us again, I think there's a three-legged stool on presidential housing or other housing that is used for university or institutional purposes. Can you remind us of those rules?
I can. So let me think back to it. But, the code section that we're looking at with this is section 119. And so really what that does is it essentially allows to be tax-free fringe benefits for employees of a business that meet certain standards. So that three-part test would involve that oh gosh, I don't know if I can go to all three parts of that test, but essentially the university's president's housing needs to be on the business premise. And Kim, if you have any insight into what this is, but it's on the business premise, it's for the convenience of the employer, and it can't be a benefit of employment. So it has to be a condition of employment living in that housing. So a lot of times we get questions on each of those sections, right? So you must meet all three of those sections, but in those three sections, there's a lot of nuance. What is considered on campus? Because is it really just the facility of the campus, or if we have the house off campus, is that on campus too if a lot of activities are occurring there? And really it's a matter of you'd have to dig into the code and regs and look at your specific situation. It's always facts and circumstance based, and document your position on that. I do know universities that take the position that off-campus housing is considered on campus, and I know many universities that say it's not within the campus, so it's not on campus. So it really would depend on the business, how that university is structured. Are you an urban university, a rural university? What does the community look like around you? And how are you, buying land around there? I don't know if Kim has anything extra to add to that based on some of her work in the tax exempt space.
I think you covered that well, Lauren. Thank you.
Okay, I got those three prongs, I think. So
I
was like,
think it's document. And I do think that one of the best practices I had heard is just also making sure, right? So you don't want it to be for the personal benefit. So I know some folks log, right, when there are events happening at the presidential house or when they're hosting donors or fundraising. So keeping that calendar to make sure that if you did become subject to that audit, you do have proof to show that it obviously is being used for business, not just personal benefit.
Exactly. Perfectly stated, right? That one, I listened. Yeah, you can break it up. That's 119. Those three prongs are just to exclude the full amount, but you can also go through and exclude partial amounts if you're going to break up the business and the personal. But again, feel free to reach out with questions if you have questions on your own, and hopefully I helped with the question that just came through.
Perfect. Thank you, Lauren. I really appreciate it. Okay, we're going to switch hats, but before we do that, we're going to push a polling question out just to make sure everyone's still here. So what are the top risks that you're concerned about as an institution or as an auxiliary or a foundation of an institution or a taxable component of an institution? What is top of mind for you this year? What are you focused on going into 24? Or what is your risk committee focus on? Just what keeps you up at night? So just curious to see where your mindset is. Some of these are all encompassing. I think a lot of what we're talking about today is F. That was no pun intended there, but it was, that is a lot of what I know is top of mind for us. And we'll just take a few more minutes and then push out hopefully those polling results specifically. But I do know I've sat through a few risk committees very recently, and folks are incredibly concerned about succession right now and the vacancy in a lot of our positions. A lot of our chief financial officers and student financial aid directors and provosts retiring, the enrollment decline. So I'd say A, B, and C have been a really big component, followed very shortly by D. But let's see what this group says. All right. Fair enough. I would expect this. So interesting. Thank you for sharing. I know the enrollment decline and the demographic cliff that is here and will continue is something that we're all incredibly focused on in higher education. So thank you for sharing your feedback on that. So I'm going to switch over. I've got a couple legal questions to give to Kim, and I'll go through these specifically. So the NCAA rules on athletes and benefits and earning money for name, image, and likeness changed in June of 21 with the Supreme Court ruling. So from a tax perspective or from just an institutional perspective, what are we concerned about? If I'm an institution and this has changed, what do I need to be thinking about? What are my biggest concerns? And how is this going to impact us? Or what are you seeing some of the questions related to this?
Yeah, thanks, Melissa. That we've seen a lot of questions evolve as we've received more IRS guidance in this space. So certainly with the Supreme Court ruling meant that doors open to opportunities to support student athletes. And for 501c3 organizations, many colleges and universities wanting to support their student athletes, there was an interest in forming these NIL collectives, name, image, likeness collectives, that would engage student athletes, provide compensation to student athletes in connection with their name, image, and likeness, in furtherance of 501c3 purposes. And not all of these collectives were formed as 501c3 organizations, but we did see a flurry of activity in this space, a lot of new formations of NIL collectives as 501c3 organizations or as fiscally sponsored projects of other 501c3 organizations. And in response to this flurry of activity, the IRS, the beginning of this summer, issued a generic legal advice memorandum in which the IRS made it pretty clear that under many cases, it didn't rule out NIL collectives altogether in terms of 501c3 status, but what we call the GLAM. The GLAM did indicate that in many cases, these NIL collectives are not going to meet the standards for 501c3 exemption. So what we have is a lot of NIL collectives were formed in response to the Supreme Court decision, applied for exemption, got exemption, and now we have this guidance, which isn't necessarily precedential, but still incredibly informative, that these collectives in many cases won't qualify for exemption. And so now we're seeing a lot of questions about whether particular collectives do qualify for exemption or don't qualify for exemption. In the GLAM, the IRS made it clear that the main reason that these many collectives will not qualify for exemption is because of the private benefit that's offered to student athletes. So when organizations, universities decided to form these affiliated NIL collectives, what may have been driving the decision was supporting student athletes, and what may have been communicated in the exemption application and in the activities and even on the website was this desire to support student athletes. Student athletes aren't in and of themselves a charitable class. So that's a problem from a 501c3 exemption perspective. And then when we're looking at the underlying activities, if what they're doing is ultimately, intended to support increasing the income earnings of these individual student athletes, that also isn't a charitable activity. And the IRS really made it clear that this private benefit doctrine is going to come into play significantly. And it's a doctrine that comes into play, generally speaking, in the 501c3 space. And you always want to ensure that any private benefits here, when we're looking at the benefits, we're looking at the benefits to the student athletes, are qualitatively and quantitatively incidental to the exempt purposes. And so when we're looking at collectives that have already qualified for 501c3 status, and just because they've qualified doesn't mean that they continue to qualify. Like the initial application could have indicated that their activities were exempt. It could have just, slipped through and the IRS very quickly approved. But ultimately, the IRS can always come back and take another look. And so we really are working with our clients on ensuring that this private benefit doctrine does not come into play. And so what that means is we want to really ensure that these collectives are engaged in activities that are truly activities that are consistent with exempt status. And we're oftentimes looking at educational activities, how these collectives are engaging student athletes to really advance educational purposes in real tangible ways. Grant making is a clearly charitable purpose, so there are often opportunities to really engage student athletes in grant making, having them serve as mini program officers. So there are opportunities for these collectives to pursue exempt purposes in a way that, in our view, can be deemed outweighing the private benefits, so that the private benefits are incidental to the exempt purposes. It's not always an easy case, and it's not always the reason that these entities were formed. So a lot of collectives are really reevaluating next steps in light of this guidance. And so there's more to come.
Perfect. And I'm sure there'll be more and more to come as we work through this. And yes, we're just hearing the tip of it with revenue sharing potential and just other things that are going on that really are going to impact our organization. So I do think this may be a continuing standing agenda item for future town halls as we move through this process and make sure we have all of our policies in place. Perfect.
Yeah. Yep.
Switching to another SCOTUS case, the mic drop right before they ended session last time. So let's talk a little bit about the race-based admission ruling and what does this group need to know? I think we've all read it. I think folks are making some early decisions. We've seen them out there in the media, this school, that institution, dropping it or moving to a different type of admission policy. But really, what could you tell this organization and just what to watch out for, what to think about as it relates to that ruling?
Yeah, well, certainly the university space is more directly impacted, very directly impacted by this ruling. So, I work with a variety of types of tax exempt organizations, and the university clients certainly are most directly impacted, as you all know and have seen, I'm sure. The Supreme Court ruled against race-based decision-making in college admissions. The Supreme Court ruled that it was a violation of the Equal Protection Clause of the 14th Amendment, and that it also violated Title VI of the Civil Rights Act. And it applied to UNC, which is a state institution, and Harvard, which receives federal financial assistance and therefore was subject to Title VI of the Civil Rights Act. And so, it's very clear, the ruling is very clear when it comes to admissions. What we are seeing certainly is that there are race-based preferences, and there's been a real desire to provide support that is race-based in a variety of different contexts. So in addition to evaluating whether or not a particular admissions program and policy complies with this ruling, there's also a need to ensure that other programming is consistent with the evolution of the law in this space. Many of you may have heard, it's very public, of the Fearless Fund lawsuit, which was brought by a related organization, the American Alliance for Equal Rights, I believe, but same founder as the Students for Fair Admissions, brought a case against Fearless Fund, which is a fund that was formed to support Black women entrepreneurs. And so the basis for that case was not Title VI, not the Equal Protection Clause, but instead Section 1981 of the Civil Rights Act, which prohibits the use of race in contracting. And that case is a case that many of us in the tax exempt space are paying a lot of attention to, because that is an area of focus that a lot of organizations, not just universities, really are really focused on. There are many scholarship programs that are focused on drawing in students of a particular race, many grants programs, And so the legal arguments that are being made and the challenges that are being made in that case, we're watching very closely. There are some First Amendment defenses, protections that are oftentimes that are being raised and were even raised in connection with this request for a preliminary injunction that was made in the case of the Fearless Fund. And the appeals court very recently overruled the district court and issued the preliminary injunction, which barred Fearless Fund from moving forward with its current application round. And it rejected this First Amendment argument in the name of Section 1981 and providing that the First Amendment doesn't allow or provide for contracting regimes that are race-based. And so we're certainly watching this space very closely. We're supporting clients with a number of different types of programs, not just admissions, grant making, other types of programs, and helping them to understand the implications of these rulings on their activities. And then, there's also the larger question of tax exemption. Certainly waiting and seeing on that piece too, but there is a doctrine related to public policy and violating fundamental public policy that 501c3 organizations cannot do. They also can't engage in illegal activities. So, as we're waiting for the dust to settle, which may be a very long time, we'll see how the law evolves and public policy evolves and the impact on the tax status of organizations in this space.
No, I think it's perfect, Kim. I think this too will be a standing agenda item in our town halls for years to come as we go through this. And I foresee future rulings and other cases coming out of this in some ways, as you say, to try and promote, an inclusive environment at some of the institutions.
Yeah.
Okay, perfect. Thank you so much. Well, I am going to switch over to our auditors. And before I do that, we'll do another polling question as we go through. So just curious as it relates to that, have you at this point or anyone else in your institution amended your policies for the ruling, or did you have to? And if you don't want to answer, you can just say in process. But I think it's really interesting in seeing the movement where some of the folks have already modified some of those policies or maybe some of the essays that they're asking to be submitted in trying to achieve our DEI or ESG goals in conjunction with really complying with the law as it stands now. So perfect. Really appreciate the feedback on this one. I think we can go ahead and push out the results of this poll. Okay, it's good to know. I think we're going through a lot of legal review and a lot of committee review. So this is not surprising to me that this is going forward. I'm assuming some of the no's may have not had it in there or maybe just different consideration. Excellent. Tammy, I'm going to switch over to you. So Tammy sits on the AICPA Government Audit Quality Control Executive Committee, which is a liaison committee with the White House Office of Management and Budget. So she gets to get a great preview into what's going on with the modification, which is out there right now for your comment on the uniform guidance changes, as well as the upcoming compliance supplement for 24, whereby we use as our guide to do the audits for the federal compliance piece for both our public and private universities and their supporting organizations. Can you talk at a high level about some of those key changes that we're expecting or what we need to watch out for?
You bet. So with regards to the compliance supplement, we're still pretty early in that process, although I will say that Department of Education did provide us with a draft of the Student Financial Aid Assistance Cluster already this year, which is much earlier than last year. And that's really been good because in the past, we've had issues with the way that the compliance supplement has been written as far as certain audit procedures that we feel auditors really cannot do, or they're just very excessively time consuming. We have that first draft. We have looked through that. One of the things that the GAQC has been encouraging the federal agencies, so not only Department of Education, but all federal regulators, is related to reporting and some of those key line items that they want auditors to test. So I believe that we will see some additional guidance with regards to which key line items are there. We're also, we believe it looks like there will be some information within that related to a new program for the prison education programs, where there's Pell Grants for confined or incarcerated individuals. So we're expecting something there. I do want to just briefly say that with regards to the 2023 compliance supplement, which we're all working through those audits now, last Thursday, the Federal Student Aid, they issued an electronic announcement to provide some guidance to institutions and auditors related to evaluating institutional compliance with requirements for using a servicer or a financial institution to deliver credit balances to a card or other access device. And what they've found is that the information needed to perform some of these suggested audit procedures might not be available to the institution under audit. And so they have amended that requirement. And so that's, again, just something to be aware of. With regards to the uniform guidance, that just on September 21st, there's been a lot happening here recently. OMB did submit proposed guidance for publication into the Federal Register. Once it hits the Federal Register, you have 60 days to provide any comments on that. So I certainly encourage everyone to look through. There's a lot of clarification to the applicability of the various requirements and terminology within the proposed guidance. In addition, I saw some changes to include just additional requirements related to acts that directly support or advance trafficking of persons, additional requirements related to discrimination, and changes to whistleblower protections. One of the significant changes that is in this proposed guidance is related to the threshold requiring a single audit. They are proposing that that be increased to $1 million from $750,000 in federal expenditures during the year. That will not change the type A and type B determination related to the major program determination. It's just the amount for whether or not a single audit is applicable. Another one of the changes within that guidance is related to the de minimis indirect cost rate. They're increasing that from 10% to 15%. And then just something else I wanted to point out is it looks as though they are wanting the CFA, the Schedule of Expenditure of Federal Awards, to identify the recipient of the federal awards for audits when there are multiple recipients that are covered in that single audit. So we see that happen a lot when a state or institutions of higher ed have more than one recipient, and it looks like they are going to want that CFA to disclose who is receiving those funds. So that's something, again, that you might want to comment.
Perfect. No, I think that's excellent. Although bummer on the major program number. I was hoping they would increase that. But it's movement. So we do appreciate that. No, thank you so much. And then as of 10/1, we flipped over on the Federal Clearinghouse to the new process. How is that going? Any feedback so far you've heard? And maybe you could, if folks don't know, maybe take a minute and explain what's happening there.
Yeah, so for those data collection forms, the Federal Audit Clearinghouse has had a site, and that site is moving to GSA, or the General Service Administration. And so that they've been working on this. This was supposed to happen last year. It was delayed to this year. So for 2023 audits, everybody's been on hold to submit those data collection forms. They did open the site a little early. It opened on September 28th. And as of midnight last night, the old site was shut down. So you can no longer put 22 audits or prior into that old site. Everything is going to have to go into the new site. A few caveats with that. Right now, they are only accepting information for 23 audits. If you have something that is for 22 or prior, the new site is not quite ready for those at this point in time. So they are hoping to start accepting those late submissions on November 1st. So we're hoping that will happen. Some of the things just to be aware of is, a lot of us use that site to search for prior audits and information. And right now you will be able to obtain 2016 through 2022. That is still on the site through December 31st of this year. At that point in time, the data is supposed to migrate to the new system. So the history should be there now on the old system, but that will migrate to the new system by the end of the year. Some things that we've heard about, just to be aware of, there have been a few issues with this new site. First of all, you can't review the entire data collection form as a draft like we used to. So you used to be able to submit all the information, and then you could print off a draft that could be reviewed by those in your organization, as well as those of us in public accounting. And so this is really making it difficult for people to review. It's my understanding you can review the first few screens, but not the CFA. So the JQC, we have passed that information along to the GSA. Also, it's my understanding that when the form is ready for submission, if you find that there's a change that needs to be made, you're going to have to start all over from scratch to fix it. They are aware of this, and it's my understanding that they are planning on updating the system so that that won't be the case in the future, but as of right now, that is a problem. Also, the site does not accept negative numbers. The form itself won't balance if you try to put in negative numbers. And once you've started the form, you can't add people after the fact. So you want to make sure that you know who all is going to need access to the site before you start, get them added at that point in time. Those are kind of the biggest challenges so far.
You probably couldn't see me because you were speaking, but I was shaking my head. This is going to be a hard June 30th submission period.
Yeah, for sure.
Appreciate it. Well, anything you can do to advocate for getting those solutions. Appreciate you giving folks the heads up. So we will try not to make mistakes and go back and start all over again.
Yeah, right.
Perfect.
Oh, one other thing I did want to mention, sorry, and this is, I think, important for auditees, is in the past, CPA firms could submit the data collection form on behalf of our auditees. So we both had to certify that the information was correct, but once both the auditee and the auditor had certified that information, the auditor could submit on their behalf. We no longer will be able to do that. So auditees are going to have to submit those forms.
That's a great point. No, thank you for that.
Yeah.
Excellent. All right, Tammy, I am going to move on to Matt, and I think we're going to skip the next polling question just because we've got a plethora of questions to still go through. So Matt, I'm going to start with you, and I think there are a couple of things that we did advertise, obviously, on our announcement that we wanted to cover, and one of those was just lessons learned and some of the high-risk items related to the schedule of financial responsibility ratios. And so I think if you could talk to us a little bit about what are some of the common errors that we are seeing. And then we also did get a question asking, well, do I even have to show the calculation in the footnotes or a supplemental to the financial statement? So maybe you could speak on both of those for us today.
Yeah, thanks, Melissa. So unfortunately, we don't have a lot of new guidance from the Department of Education, but certainly they are getting more comfortable with these calculations. And so therefore, their comfortability is coming with additional questions. And so we are getting a lot of, just really cognitive thought processes when they go through the entire financial statement. So for example, the biggest challenge has been really understanding that key implementation date that happened back in July of 2019 and understanding when we do have either new debt that's issued or new fixed or capital assets that are being added, really ensuring that is being segregated in your schedule so that, again, when the Department of Ed looks at your statement of cash flows, for example, they see those additions to fixed assets in the current year, they're challenging us sometimes on whether the accuracy of those bifurcation of assets is correct. The other that we're seeing really being, significant has to do with refundings of debt and really being challenged on, are those still for capital purposes? So one of the recommendations we've been having with our clients is really clarifying that within the footnotes themselves of, yes, this is a refunding, but it was refunding debt that was originally for capital purposes and therefore should still be classified as such in the schedule. Now, your question about whether the calculation of the score is required, the answer is actually no. I know a lot of boards and committees like to have that information at their disposal and get clarification to see if there are other risks that might put them on the heightened cash monitoring system. But ultimately, at the end of the day, the score itself is not required, but all the information that has to be reported in the easy audit submission is. And so one thing I always get questions on, or we see errors, is if something is not applicable this year or it's a zero balance, that might be left off the schedule unintentionally or maybe intentionally, and that's going to cause some red flags with the Department of Education because they really want that negative confirmation that really everything has been addressed in that schedule and that even if it is not applicable or is a zero balance, you're still reporting that as such. The other thing that has been kind of a challenging area, of course, is related party disclosures. So even if your organization has no significant related parties transactions in the current year, they still are expecting some kind of footnote disclosure added to the audit report that confirms that expectation and maybe even a policy associated with how you evaluate related party transactions. And so that's another key area that's really important. And then I will say that even if your score it does end up being above a 1.5 overall. If you are running into a situation where potentially you have debt that you are not meeting your covenants and you're not getting those waivers for those covenants, the Department of Education may still trump over that decision about your overall score and challenge you on whether you're meeting the requirements under the Higher Education Act. So make sure you're getting those waivers if you run into that situation, or be having good communications with your representative so that they're aware in advance and you're adding additional disclosures that might be necessary as a result.
Yeah. And I just wanted to add to something you said and be very clear in this, Matt. Even if you have no related party transactions, you need to say, I have no related party transactions in a footnote, or you will get a letter. So something that we've been running into over the course of 2 years. No, that's perfect. It's just, it would be great to have some guidance, but I feel like we're learning as we go. So just making sure that we're sharing with all of you some of the items that we are seeing. So that's perfect. Really appreciate that, Matt. So a couple things left while we just have a few more minutes. We've got a new standard. It's going to be impacting our FASB reporters. So for our FASB institutions on this call, CECL will be likely in effect for everybody for next year. It is starting now. That policy needs to get in place now. Just a couple tidbits on how to get ready for this, maybe you could share.
Yeah, absolutely. I think this one may have been falling under the radar a little bit with how many other standards our FASB reporters have had to implement over the last several years. But one thing to think about is that this is sort of linked to your Topic 606 or exchange-like transactions. It also is applicable to your loan programs, other held-to-debt maturity investments, for example. There's a lot of potential items that you might not have considered that will be scoped in under this standard. And as you mentioned, it will be applicable for pretty much everyone going forward from this period on. One thing to be thinking about is, for example, your student accounts and your student loans. There is a pooled method that may be applied when applying the standard. I guess I should stop back and maybe give more guidance first about what this impact will be. So, historically, when we thought about bad debt, and now credit losses will be the terminology going forward, is looking at the probability of not collecting or fulfilling that entire investment or asset balance. And this new standard really requires a more perspective look on what is forecasted for the future, what is that group of individuals or payers, and what is the likelihood that they might not be able to fulfill on that obligation. And what's going to be tricky here is you're required already to assess the contract that you're entering into and whether there are inherent types of risks associated with collection. And so this really is applicable to what you've expected to be collected and those changes that result after the fact. And so if there is a material impact, we don't expect this to be, especially for many reporters. It is a retrospective review. So you'll want to look at your assets in this category at the beginning of the year. And in theory, if it was material, you'd have a cumulative change to your opening net assets for this impact. Again, we don't expect that to be the case except for very unique situations. But really going forward, you're going to have a different footnotes that are at least highlight what this policy is in place for you and the impact of what you're doing to look at your different pools. So again, for Perkins type loans, institutional loans, all this will apply. But the good news is you're probably getting a lot of great information from service providers that are helping you with that. So if there's a default rate that already exists, that might be really helpful for you in making these assumptions and estimates moving forward.
Perfect. Excellent. Let's do one more. We want to make sure that I cover this little portion here on the leases. Well, and actually on that standard, I want to go back and say very specifically, Matt, that this contributions receivables and pledge receivables are scoped out of the standard. So do keep
Correct.
that in mind. That is a little bit of forgiveness and that we don't have to worry about that and just make sure that those are not considered. And I mean, obviously it might be easier to really look at all of it at the same time and revise your policies, but it is not required under this standard. And maybe just in the last minute or so, can you go through tidbits on leases? We've got, most of us have already gone through, but there are a handful of higher education institutions that are private or a handful of our publics that might be still finishing up some of it, or just lesson learned for as we revisit it each and every year, maybe a couple things to keep in mind that you've seen as an auditor.
Yeah, absolutely. I think, for a lot of institutions, it was a little bit of a surprise of this embedded lease search requirement. And that really does not go away just because we've implemented or have finished going through this process. It'll be an ongoing exercise that you'll want to review your contracts to determine, is there an embedded lease, meaning that are you gaining some type of right to use an asset, but you're using other forms of compensation to obtain that asset. And so we are seeing more and more situations where contracts are resulting in these. So to continually reviewing that is key. Another one will be revaluation of those interest rates. So if you're a private institution, most likely you're using a risk-free rate. And so that rate will change. You'll probably have a range that's in your disclosures. That's usually a red flag. If there's not a range in there, that something maybe has not been applied quite correctly. Or for our GASB reporters, ensuring that you're using that incremental borrowing rate, which again may change over time based on your own financial situation. One thing I'll say is that during the year of implementation, there was often a difference between the asset and liability balance being reported because of some historical deferred rent. But now that that concept has gone away, it's usually a pretty good check. If your implementation asset and liability don't agree, there might be something slightly off in your calculations. Just review that and revisit that. And then supplementary cash flow information. Whenever there's a modification, we want to make sure we consider that as well and that all the disclosures are being applied appropriately.
Perfect. Sorry to rush you there, Matt. Thank you so
No
much
worries.
for that. That's good. Those are good tidbits. Thanks for the bullets on that too. Appreciate it. I just want to thank everybody, and as I close out, I just want to remind folks, there is a new audit standard on noncompliance with laws and regulations. You may get a little bit more questions from your auditors this year. So just a heads up on that one. We really do thank you. We really do appreciate the questions. We have a lot of content. A lot of it we didn't get through today. So we will probably schedule another town hall in the next quarter to go through the items and as some of the regulations come through. So here's a way to stay connected with Moss Adams. We have a regular series of thought leadership that we put out there, but we just are incredibly grateful for your time and attention today and absolutely love serving this sector. So thanks for letting us share our nuggets with you. And we will see you at some of these upcoming events where we have presenters or will be present. I think we're presenting at all of these conferences. So we hope to see some of you at these. And I wish you the best October. And if you're finishing up your audits, best of luck as well getting to those board and audit committee meetings. So thanks, everybody. On behalf of Moss Adams, have a great day.